Every morning, the countdown begins for the markets with meticulous research and analysis designed to help you capitalize on the trading day. Beaming live from the CNBC-TV18 Motilal Oswal studio.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. We are coming to you live from the CNBC-TV18 Motilal Oswal studios, middle of the week, Wednesday morning. I'm Prashant. With me, my colleagues Rima and Nigel. Guys, good morning.
Hi, good morning. So bond price is up, crude price is up.
Bond price is down.
Okay, so yields are high. Sorry, bond yields are higher, crude prices are up. Question is, equity markets up or down?
Well, that's right. It's going to be an interesting day in terms of equity market. But for me, the sports action was quite encouraging overnight. Arsenal, they are the English Premier League champions for the first time in 22 years since the time I've been at CNBC-TV18, which is very, very long. I've never got a chance to say it on television. So Arsenal's back in the game, and I'm feeling pumped this morning on the sports action.
Well, I know a lot of family groups, there's congratulatory messages going on.
It's been a long while. So far, it's been a long while. When you go for a drink, Prashant, to watch a game in a club, you wear something, and then, if they win, then you open up. Most of the time, we are zipped up. Oh, no. But this time around, here we go. Arsenal all the way.
All right. Well, let's just take it from the top. And, oil's at $111 odd a barrel this morning. So we are... not very much different from where we were yesterday, from where we were day before yesterday, a dollar here, a dollar there, but basically up. And that's a problem. Now, Trump said that Iran had as long as early next week to come to the table. Well, we've heard this before. By the way, yesterday at the same time, we were reporting that Trump put out on Truth Social saying that, he's held off from striking Iran because of the GCC countries have said that, well, we are talking with Iran, so please don't strike, etc. There is New York Times reportage which suggests that it's not because of the request from GCC countries. It's basically Pentagon's assessment that, Iran has basically rebuilt a fair bit of its capability to wreak havoc in those regions, in the Persian Gulf countries, US bases and whatnot. So, this is interesting. But anyway, rhetoric still, oil prices not impressed. NATO was, of course, said to be discussing helping ships through the Strait of Hormuz if it isn't reopened. And this is the, punchy bit. Early July, they're saying, well, so they're basically saying, well, in all likelihood, it stays shut in June. And if it's not opened by early July, we'll come to help. So not encouraging again. S&P down about 0.75%. NASDAQ was down about 0.8%. US equities have been down for 3 trading sessions now, but they're still up quite a bit for the year so far. And this is the bond action, right? So the general assessment has been that that bonds perhaps it's a bullish environment for bonds. But that camp is getting smaller and smaller. And we'll talk more about this in a bit from now. The 5-year on the US Treasury was up 9 basis points to 4.32, which means bond prices were down. 10-year, 8 basis points high, about 4.6. You'd wonder what is the next level? There is no next level except the January 2025 high, which is 4.8, which is not very far away, by the way, from where we closed yesterday. And, of course, the 30-year was up 6 basis points to 5.18. And here, the next round number is 5.5%, which is also, by the way, be a 22-year high. The unshakable belief has been, and maybe rightly so, and it's still there. Those who believe that it cannot last. The war cannot be very prolonged. It has to end. It has to wind down. So this oil shock and hence consequently inflation shock is transitory. And while that is absolutely the correct belief to have, it's just that it's been 2 months and the clock is ticking on the way to completing 3 months of this conflict, the strait being shut. And I think markets are finally starting to reprice themselves higher. So it's more technical in that sense. It's not a big fundamental shift. It's not a bond buyers strike as the headlines screamed sometime middle of last year. It's not that. It's not US exceptionalism, which is being questioned again. It's basically simply core inflation plus the energy shock and the market trying to reprice some of that higher, slightly higher. Now, in terms of further cues, NVIDIA will report earnings tonight. SpaceX, by the way, is also expected to file the IPO filing, to do the IPO filing later today. So we'll see. It should be interesting to read. Now, rupee made a new record low at 96.6 yesterday, and that's been the one-way trade, right? Nifty's gone up and gone down, and it's done the round trip, but the rupee, the currency, has just been sliding one way without really too much of a halt on the way. And the yield jump that we saw last night and the dollar strengthening, by the way, the dollar strengthening, even if the margin is completely against any expectation out there, the big macro traders all have had the view that dollar is going down, not up. So this is going to cause, I guess, a little bit of change in positioning, posturing, and of course, maybe a view as well. We'll see. Now, but this is not good news. Yields, dollar, both going up, not good news from a macro standpoint. Nifty needs to get past the range, by the way, is 23,800 on the upside and 23,300 on the downside. Basically, the range is just shifted down. And we need to get past 23,800 on the way higher for anything good to happen from here. And support is 23,300, and a break of which will, if you take the equalization level of the last fall, the 23,300, if it goes, then you're looking at about 22,800 or so. GIFT Nifty gives you a quick sense of how we're likely to start. We'll pick it up from there. 190 points lower is the indicative open. Nigel has walked across the wall with the F&O positioning and the cues. Nigel, take it away.
Well, going by the GIFT Nifty fall and the kind of fall that we have yesterday, the Nifty actually will come to a very, very interesting level from where the bulls could be a little bit interested as well, because yesterday was more than 100 points from the top. And today, this morning, in fact, the GIFT Nifty suggesting a big downtick as well. And yesterday, there was clearly an expiry-related factor that played out. That's the weekly expiry, because the fall started just in the last 45 minutes to around the 30 minutes or thereabouts. So yesterday's fall, to some extent, will be attributed to the weekly expiry factor. And it appears we're more in a trading market, and it'll be very, very brave, actually, to take a solid bullish view. With crude oil prices at around this $110, $111 a barrel, and the US bond yields as well spiking up at around 4.65%, or difficult to take a bullish view on Indian markets with yields and as well as crude at these levels. So this is a trading market, and with the kind of downtick that you see today, probably you'll get a bit of a trading rally that could play out from the day's low. The Indian rupee, though, continues to slip, and that's clearly weighing on sentiment. You want some kind of stability. I've been seeing this for many, many trading sessions, but it's falling just one way. Just take a look at that. That's a one-month chart of it. You know, the rupee moving very, very swiftly from around 93 to around 96.5 of thereabouts. And the FIs, after giving some hope in the last couple of trading sessions, they returned to their selling ways. So they sold close on 2,500 crores. The DIs, they bought 3,800 crores. So it's offset that. However, what was positive yesterday is what the previous play told us. The broader markets, you had the mid and the small cap indices that actually outperformed, though the headline index came off, and you'll want to see more of the same. Maybe the headline index is in a phase of consolidation in a bit of a range, but the broader markets perform, makes your portfolios feel good. So more of the same will be on the wish list. As I said, the FI sold a little bit in the cash market, and they added shorts as well in trade yesterday. So they added close to around 7,000 short contracts, and the short position continues at around that 88% or thereabouts. Moving to the options data. Today we start we start focusing on the next weekly expiry, which is on the next Tuesday. And there appears at times there's a bit of a strategy that's taking place. And this time the strategy appears to be coming in at around this 23,700 call as well as the 23,700 put. So the strategy would be write both those two strikes and look to pocket the premium, which in this case will be around 450 rupees or thereabouts. So then the broad range you're working with is around 23,250 on the downside. On the upside, 24,150. If you're playing that strike, that 23,700 odd level. In terms of levels you're looking at, 50 DMA, we went to that mark yesterday, it got breached. So that's the crucial resistance zone that you're looking at. While on the downside, the recent low will be a bit of a support. But as I said earlier, the headline index appears to be in a bit of a range. And from today's low, maybe we see a bit of a bounce as well. But it appears we're in a trading range. The broader markets is what you would like to track, and you like to see more of the same, with the mid and the small cap indices outperforming and higher number of stocks advancing than declining. So let's see how this goes.
It was a good day for the broader markets yesterday. Key indices up nearly 1%. Today, what's on tap is the Apollo Hospitals Grasim numbers. You've got the US FOMC minutes. And as Prashant said, NVIDIA's numbers will be tracked closely. Expectations are high, 80% plus revenue growth, 130% plus growth on the profitability. But let's get back to the updates from West Asia. US President Donald Trump says the war with Iran will end very quickly. Addressing the annual congressional picnic gathering, he added that a resolution would push oil prices lower and emphasized that preventing Iran from obtaining a nuclear weapon remains a priority. Listen in.
We're going to end that war very quickly. They want to make a deal so badly. They're tired of this. Should have happened for 47 years. Somebody should have done something about it. And it's going to happen, and it's going to happen fast. And you're going to see oil prices plummet. They're going to come down. There's so much oil out there. They're going to come plummeting down. But even with that, the stock market's at an all-time high. 2.5 months ago, we hit the best numbers that we've ever hit as a country. Jobs, the best. Everything was the best. Stock market, the highest. And I called my people in. I called them in. I said, congratulations, everybody, but we're going to have to make a little journey down to a place called Iran. We have to stop them. They have nuclear on their mind, and we're not going to let them have a nuclear weapon. And we've done a hell of a job, and I think we're going to be finished with that very quickly, and they won't have a nuclear weapon, and hopefully we're going to get it done in a very nice manner.
Okay, that's Donald Trump for you. Let's invite Adrian Mobat, investor Hong Kong, SAR, joining us on the show. Adrian, thank you very much for joining us. Let me begin with the big surge that we're seeing in global bond yields. The 30-year yield in the US at a 19-year high, very high yields in Japan, France, Germany. And in a way, it's unsettled the equity market. So far, there isn't panic selling, no large selling. But what is it indicating? We've got about a 35% chance of a rate hike towards the end of this year, just as Kevin Warsh takes charge as the Fed chair. What's your assessment of the rise that we've seen in gold prices? Bond yields.
Inflation is usually the biggest threat to equities. You know, when inflation moves higher, you're going to get tighter monetary policy, you're going to get higher discount rates. So the tighter monetary policy means less growth, less earnings growth, and the higher discount rate means that P multiples compress. So the market should be anxious about this. The first thing to look at is bond volatility, and we are seeing the MOVE index moving higher quite quickly, not quite at the peak we saw just at the start of the Iran war. But I'm turning quite cautious on global equities because of what we're seeing here. Now, if we think about the inflation dynamics, the headline data is extremely poor. Poor inflation is also poor in most countries, US at around 2.8%. If you look at two-year yields at the beginning of this year, they were around 3.6%. They're now up to 4.1, which is clearly indicating that the risk now is for a tighter Fed policy, not an easing in Fed policy, which was the general consensus at the beginning of the year. Equity markets are high. It is important, though, to look at the details there. The equally weighted S&P didn't make new highs more recently. It's been a more narrow market. Since the start of the Gulf War, the average semiconductor stock is up about 25%. Similar sort of move in tech hardware. You've only got 3 of the major subsectors up since the start of the war with Iran. If you look at the average consumer discretionary stock, it's down by about 13%. So we are within the markets already beginning to see the details of the anxiety for investors. Now, if I go back to the semi story, look, the earnings from these companies have been incredibly good. It looks like a very tight market in terms of supply of semiconductors and hardware relative to CapEx. But then this is now reflected in the share price after very dramatic moves. So I think investors should be cautious until we get some resolution here. Now, you've all heard of the taco trade. The new trade is the nacho trade, which is not a chance Hormuz opens. And at the moment, it's really difficult to see any common ground between Iran, the United States, over what to do with the Straits of Hormuz. It's too much of a point of leverage for the Iranians to quickly give up on it. And so I think there is a risk that we go through the summer months, start to see more and more headlines of rationing of refined products, textile companies having to shut down production because they can't get polyester, plastic supplies interrupting manufacturing because key components are not available. So I think it is a time to be cautious, and the bond markets are raising the flag.
Yeah, but you got to be cautious on things that have done exceedingly well. Adrian, good morning. India has not done well. I mean, it's not done. It's been one of the big underperformers in that sense. But it's a tough situation, right? I mean, the currency is 96, past 96, and now. And by the way, we got to 96 without any big strengthening in the US dollar. And at 96 plus, you got yields which are starting to move higher and the dollar which is starting to strengthen a little bit. So, maybe there is some buffer here because we've already sort of lost quite a bit. But how do you assess the situation for India?
I think there's arguably a technical buffer in the positioning is weak with international investors in India. But I don't see a near-term change in the challenging fundamentals. So the challenging fundamentals are, a deteriorating current account position, real pressure on the Indian consumer because of prices. And when we think about the situation in agriculture, and this is the global issue, today's agricultural prices are yet to be really impacted by what's going on with the closure of the Straits of Hormuz. It's the crop that comes out in the third quarter of the year that we need to start to be concerned about because farmers couldn't either get the diesel or couldn't afford the diesel to run their equipment, and they couldn't afford the fertilizer. And so the risk is that the pressure on the EM consumer that is more susceptible to energy and food prices actually increases as the year moves on, unless there is a resolution of the Strait of Hormuz closure.
Hi, Adrian. Good morning. Good to see you. Well, the FIs have been selling even the Korean market, the Kospi. And the Kospi has pulled back 10% very, very swiftly. But that market went up one way, so, didn't require any big reason, though that strike at Samsung and the other factors are being down there. What's your take, though? Why are they pulling out this money? Are they redirecting the money to some market? Wishful thinker would say, hopefully it comes to India because they've been selling India so much. But what is your gut? Where does the reallocation happen to out of the Kospi?
Yeah, I think a 10% pullback after such dramatic rallies is relatively modest. This is a high vol market these days. I would, if I was trying to explain it, it would be back to the comments I made earlier on bond yields. So as bond yields move higher, you tend to see long duration tech stocks being hit by that. So, a little bit of profit taking in a market that really has driven EM performance year to date is probably quite reasonable.
No, you're absolutely right. Let's just put up I think you gave us a headline, nacho trade. We should put the nacho trade at the bottom of the screen. Not a chance, Hormuz opens. That's a nice one. It's painful, but it is what it is. Adrian, just a quick word on the question of what we can do, right? There's been a fair bit of talk around it. So maybe some firefighting will be required because rupee falling currency can be a buffer as well, as many have suggested. But like an out of control falling currency then becomes a problem in itself. So you got to maybe do a little bit of firefighting here. But, so to attract more dollars into the system. But if rates in the US are going up, that becomes doubly difficult, isn't it? Because it becomes very expensive then to attract those dollars.
Yeah, it is. It's a very tough situation. So it's reasonable for EM governments to want to help their population deal with this shock, particularly if it's a temporary shock. But that adds to the fiscal deficit at a time that local yields are having to rise out of reflection of rising global yields. And if you already have weak momentum in your currency, that can often put even more pressure on the need to have a higher interest rate differential. And so this is a very unpleasant squeeze. And I think while this unpleasant squeeze is going on, it's going to be difficult to encourage significant foreign capital to come into the Indian market.
So, Adrian, when you're cautious on global equity markets, turning cautious, what exactly does that mean in terms of downside from here on? Particularly when we look at emerging markets or even top down from the US markets, if you have a view, what's the extent of repricing we should see?
Yeah, so I think we could test the lows that we were seeing in late March, early April, with the move that we've got in bond yields. At the moment, I'm struggling to see the drivers of equities going higher. We've already had a very good results season for the tech space, and that's been reflected in share prices. The outlook looks much more one of a downgrade in GDP growth, and therefore possibly a beginning of a downgrade in what has been a relatively positive earnings revision cycle for the US equity market. And so I think it's the US equity market perhaps leading other risk assets lower.
Yeah. So if you were a global investor, where would you hide?
There's nothing wrong with cash, and it's probably US dollar cash. There's always a great danger when you see a risk-reward environment deteriorating. You think, well, I need to find something else to buy. Well, maybe the best thing is to sell the asset that you think might be going down rather than going up. And if that sits in cash yielding 3 3/4, that's probably okay. It's better than assets that's falling in value. But you think about cash being at the short end. You don't want duration at this point in time. Now, we might see yields spiking even higher. We did go above 5% on the US 10-year yield. UK gilts are already through the 5% mark. You made a comment in the introduction of how 30-year bond yields are at a multi-decade high. At some point, I think I'd probably look for a bit of duration in the US bond market if 10-year yields move above 5%. And I think that's where you would start to put a little bit of risk on in taking on some duration yield when a yield curve is now steep enough to do that before necessarily jumping straight back into equities.
Well, great conversation, Adrian. Thank you very much for joining us. And, you've prepped us to be a little cautious and be a little wary. Bond investors are being wary, and they're not jumping back in yet, maybe at higher levels, as you said. Thank you very much for being here on the program. Okay, all right. Well, let's just quickly run you through what's coming up here on the show. So we'll have 8:35, Harshit Kapadia of Elara Securities with us to talk about BEL's fourth quarter numbers and the overall outlook on the defense sector. 9:20, Sanjay Parekh is a market master of the day. Nilesh Sathe, former member of IRDAI, will join us to reflect on comments from, a top voice in the insurance space. Pranjal Bhandari of HSBC will be with us at 9:40. Macros very much in focus. We had, a discussion going yesterday morning as well. So Pranjal does that for us today. 9:50, the management of rights talks to us about fourth quarter numbers and outlook. And towards the end of the program, Lata is back. So she speaks with Citi, Samir and Chakrabarti on the rising pressure on India's macros.
The time to slip into a quick break. We've got a lot of stock-specific action tracked tomorrow. We'll get to that in just a bit in our special Top 10 segment. But I highlight a few of the stocks. We're looking at Hindalco, BPCL, Mankind Pharma, Healthcare Global, Hudson Agro, Godavari Power and Ispat, as well as, Ask Auto. All of them will be reacting to positive news flow. On the flip side, PI Industries, Orkla India, as well as Z Enterprises will be reacting to negative news flow. Take that break, come back, get into further detail on all of those names.
Welcome back. Let's talk stocks. Our research team is standing by with CNBC-TV18's list of top stocks for the day. Good morning, everyone. But Nigel, let me begin with you with Novelis's numbers.
Well, that's right. Let's focus on Hindalco. That stock could react positively because results of Novelis improved on better scrap spreads, though there were some one-offs. The total FRP shipments came down by close to around 12%. That was hit due to the Oswego fire. However, the adjusted EBITDA came in at around $450 million, with the EBITDA per ton at around $544 per ton, as it was impacted by the negative $50 million odd from the Oswego fires and another $27 million due to the tariffs. But that was offset because they got $41 million owing to that insurance, coming in from the floods that they saw just in the past year or so. There were two problems, though, with the numbers, besides a better-than-expected operational performance. One is the fire impact. Now they're talking about the total free cash flow impact of around $1.7 billion. That's higher than the $1.3, $1.6 billion they were talking about earlier. And the second factor is the net debt to EBITDA. That rose to a 23-quarter high of around 4.1 times odd. So that's a bit of a niggling worry because the debt number has swelled up as well. On the plant-specific guidance, they're saying the New York plant will restart in a couple of weeks. That's earlier than what they spoke about earlier. And the Bay Minette plant, that remains on track to come on stream by the end of this calendar year. On the guidance, they expect to be free cash flow positive by the end of FY27. So that's good to hear. So an improved performance, a couple of other factors weighing, but going with a tinge of green on this name for today. Hopping across to Sonal, though, BPCL came out with a set of numbers. Morning, Sonal, how are they?
The numbers were better than what the street was working with, like HPCL and IOCL, because of high inventory gains in the refining segment. Revenues came in at 1.2 lakh crore rupees, lower than the poll. However, EBITDA came in at 10,061 crore rupees. This compares with a poll of 6,980 crore rupees. Margins accordingly higher at 8.5%. Profits was lower than the poll at 3,192 crore rupees because there was a 4,000 crore rupee impairment loss this time for one of the subsidiary that the company reported, and hence the profit slightly lower than what the poll number that came up with. No GRMs were reported in the press release, so we'll have to quiz the management on that in the conference call. However, they did see a marketing inventory gain as well of around 1275 crore rupees, which compares with around 500 crore rupees. There was a huge forex loss as well, around 1000 crore rupees versus 45 crore rupees on a YY basis. But again, these are backdated numbers. These companies have taken a price hike now. They're still making 750 crore rupee loss per day in their marketing segment. So the future outlook really depends on any further price hikes if they take. That is something that could lower their losses in the marketing segment.
All right, Sonal, thanks very much for that. So that's BPCL for you, Mankind Pharma and HCG in focus. Ekta's here with those. Ekta, morning.
Morning. Well, I'll start with Mankind Pharma. Good numbers. Revenue was up around 12%, which was in line, but there was a better operational performance both year on year as well as Q on Q. So the margins improved and the profit was aided by this better operational performance. So the domestic business, ex the consumer health business, was up around 13%, but the consumer health business was up around 19.8%. So good growth coming in there, and the exports business was up around 4.2%, but that's a minority as compared to the domestic and the consumer health business. HCG, good numbers, so revenue up around 11.5%, margins almost 19%. The West region was up 13%, South was up 9%, East was up 8%, international revenue, which is their Kenya operations, was up 39%. The average revenue per patient was up around 2% for the company this time. The company is also exiting their non-core fertility business, which is their Milan fertility brand. They'll be selling it for around 37 crore to Invigia Healthcare Fund, which is basically owned by the promoter.
Thank you very much for that. PI Industries, Ria joins in to tell us how the numbers look. Good morning.
Well, good morning. It has been a weak set this time around for PI Industries. Overall, for quarter four, the numbers have been below estimates, and this time around a weak quarter was expected compared to a relatively difficult a year ago base for the company. Revenue has declined by around 12%, in line with the estimates that the street was working with. EBITDA declines by 26% versus estimates of a 19% decline, and net profit also seeing a steep decline of 39% versus estimates of just a 23% decline. Margins have also contracted by 400 basis points to just 21.5% versus the estimates of around 23% margins. And even if you look at the full year performance for FY26, that has also been quite weak. Revenue and EBITDA have declined in line with estimates. The adjusted net profit also seeing a decline of around 27%, and margins have declined by 200 basis points to just about 25%. But this is in line with the guidance that the company had given, and a favorable product mix this time around has supported margins. In terms of the segments, agrichem exports have seen a decline of around 19% on a year-on-year basis, with volumes going down by nearly 14% due to a high base effect, and also the overall contraction in the global agrichem industry. The domestic revenue has also declined by 7% for the company this time around, with volumes going down by around 1%, although the pharma revenues this time around have grown by 40% compared to the previous year, and this segment contributes to nearly 6% of the total export revenue of the company. In terms of the outlook for FY27 on the domestic front, the company has said that increase in input costs due to ongoing geopolitical tensions will lead to further pricing pressure for them. On the export front, they remain cautious for the second half of FY27. However, overall, they have said they do have a positive outlook on the overall company's performance for FY27.
Okay, all right. Thanks a lot for that, Ria. Hopping across to Mangalam. He is here to tell us about two stocks, Hatsun Agro and Okla. Hey, Mangala, morning.
Good morning. So let's start with Hudson Agro. It's a good set that has come in. Why do I say that? Because, revenues have grown 15%. And remember, across the dairy industry, this time procurement prices were higher. So as a result of which, this company too faced gross margin pressure, which came down from 30% to about 27.8%. But their own cost efficiencies meant that the EBITDA margin compression was limited to just 90 basis points as against 250 basis points gross margin compression. So EBITDA actually grew 5%. And though the margins compressed, not as much as the gross margins. Add to that, the company improved their balance sheet. So finance costs came down by about 15 crore. And the net profit as a result of which grew by 18%. So going with green on Hudson Agro. Orkla, however, soft revenue growth. Volumes just grew 2.2%. And the EBITDA, as the company says, impacted by West Asia crisis and higher investments that they are currently making. So on a reported basis, the revenue grew about 5%. The EBITDA grew just by 2%. Margins compressed by 50 basis points. But importantly, the reported basis net profit looks like it's a big jump from 35 crores to about 73 crores. But remember, same time last year, there was a 33 crore exceptional loss. So you add that back and the net profit jump is not as much as, the reported numbers do indicate. In the segments as well, it was just a little over 6% growth coming in for both their spices as well as the convenience food segments. Spices were impacted by weakness in Kerala as well. So going with red on Orkla and green on Hudson.
Thank you very much for that. Sudarshan joins in with some stocks which are in the news today.
So we start with Godavari Power. It was strong operational numbers. Margin has come at highest levels that we have seen in last 3 years. Revenue was up 10%. Margin has increased by 560 basis points to 27.3%. Even guidance that company has given for FY27, especially for the volume, is looking strong. Iron ore mining volume growth is seen at 23%, and iron ore pellets volume growth is seen at 40%. Ascoto, I'm going with mild green because revenue has seen a double-digit growth. It was up 35%. EBITDA has seen an increase of 31%. Margin, though, has come down by 40 basis points to 12.1%. Revenue is also aided by pass-through of increase in alloy prices. And for FY27, company saying it will continue to outperform the industry and growth in two-wheelers is expected to continue. For Z Entertainment, I'm going with red because core business profitability remains weak. Ad revenue growth was down 4%, while subscription revenue has seen an increase of 4% YOY, and ad revenue was down in March because of West Asia crisis. On the reporting basis, company has reported EBITDA loss due to a change in estimate for premium movie rights, but adjusting for that, adjusted EBITDA was down 51% YOY at rupees 140 crore.
Thank you very much for that. Let's do a quick recap then of the top stocks. Stocks with positive news flow are Hindalco, BPCL, Mankind Pharma, Healthcare Global, Hudson Agro, Godavari Power, ASK Auto. Stocks with negative news flow are PI Industries, Orkla India and C Entertainment. Let's talk commodities now. Manisha is joining us with a complete roundup of all the action. Hi Manisha, good morning.
Morning. Thank you for that, Rima. I'll start with the crude oil prices where we are trading back above $111 a barrel. This is as the U.S.-Iran war enters 12th week and the U.S. president threatens to resume military strikes on Iran if it fails to accept the U.S. peace terms. We also do know that there are certain reports suggesting that the NATO is weighing plans to escort commercial vehicles via the waterways if the route remains blocked beyond early July as well. So various statements and various events stated in. In the meanwhile, you also are looking at the U.S. inventories in the previous week declining by 9 million barrels versus an estimate of 3. So that is also something that is supporting the prices. So while the energy and heating oil and gasoline prices are all trading on the higher side, the metals have seen a decline for yet another session. Gold fell 2% overnight. It's trading at a 1-month lows. Silver fell 5% in the overnight markets, and copper futures are now trading at a 2-week lows. There are concerns on rising inflation and interest rates. There's a sharp increase in global bond yields, and then the China retail sales, industrial production, all of that data coming on the weaker side is also weighing onto the markets.
All right, Manisha, thank you very much for that. We'll take a quick commercial break here. Up next, Harshit Kapadia of Elara Securities with us to talk about BEL's fourth quarter numbers and the overall outlook on the defense space. Stay tuned.
Welcome back. Hope you're having a good morning. Well, let's turn our spotlight on the defense sector. Bharat Electronics reported a strong set of numbers yesterday. To discuss this, as well as the other stocks in the sector, we're joined with Harshit Kapadia of Elara Securities. Hi, Harsha. Good morning. Good to see you. Well, let's talk about BEL first, and then I noticed that you have a good upside on solar industries as well. As you say, it's firing on all cylinders. BEL first. What's your view on the stock? It came out with a set of numbers closer to the end of trade yesterday. Your view on the numbers and outlook from here on?
I think the numbers were largely in line with our estimates, except the margins came much positive than what we were estimating. The outlook for Bell continues to remain strong. We still expect an order inflow based momentum growth of 25,000 crores even for FY27. There is one large order for QR SAM worth 30,000 crores is expected to be announced in first half of FY27. Since it's a large order, that's why there is a CCS committee approval which is required, and that's where it is pending. So once the meeting happens, we'll see a large order coming to them. The revenue run rate will also be upwards of 15% at least over next 2 years is what we anticipate, because they have a very strong order book of 73,000 crores. With that, large part of that order book still remains to be short cycle orders, which needs to be executed in less than a year's time. So that gives us a very confidence in terms of revenue growth momentum being there, though the base remains to be very high. So we are cognizant of that, but outlook remains to be strong. But it remains to be the most expensive defense PSU stock in the entire basket. And I think the valuation will remain to be expensive on the PSU space.
So Harshit, the conference call for BEL is today, 4 o'clock. So in terms of guidance, you're saying 15% guidance is what the street would be happy with for BEL? And on margins, what is the number that you expect?
So yes, I think street will be happy with the 15% guidance. If they up the guidance, and given the history of Bell, they have always been conservative. So if you look at the full year numbers, they have done somewhere between 16 to 17%. So they guided for 15%. So the management idea has always been to outperform their guidance, and so sometimes they also maintain a lower set of guidance. So that's one point. On margins, we think it would be somewhere in the vicinity of 28%. Probably a 30% margin would be a little bit difficult at this point in time, but 28% is easily achievable by the company.
Okay, so 15% revenue guidance with the potential for outperformance, and 28% margin guidance is what you expect from BEL later today. But you said valuations are expensive. So if the company guides for this, and you know that typically they are conservative, how would the market react? What are the valuations and how would it compare with peers? If you could just share the numbers with us.
Sure. So in terms of valuation, they are at around 36 times in terms of my FY28 earnings in the defense PSU space. Hindustan Aeronautics trades at around 27 times. Bharat Dynamics trades at around 33 times FY28 numbers. So in terms of valuation, it is expensive. So, people would add to it, but not in a great quantity unless they raise their guidance either on order inflow front or on revenue front. So those are two key things to watch out for in the call today.
Okay. All right, Harshit, let's talk about the other stock, Solar Industries. What a story that's been, right? Particularly the defense vertical. I was looking at a few numbers. If I got it correct, I think 11 years ago, they did around 10-11 crores from the defense vertical. And in the next year, they're going to do 4,500 crores from the defense vertical. Now, that's some execution from being just a pure explosives company to diversify, scale up the international business, and the defense vertical as well is very good. However, valuations are on the elevated side. What's your take on the stock? You believe that they're still firing all cylinders and you would still be interested?
You are absolutely right with your numbers, Nigel. And yes, we are still positive and we think they are firing in all cylinders. So if you look at global market as well as Indian market, what we are hearing is that there are 4 products which have been used extensively in the war which has happened. First is missile rockets, second is drone, third is counter-drone system, and fourth is ammunition. If you look at post-Operation Sindoor, these are during Operation Sindoor also, these were the major 4 products which were used. So there is a very high demand globally, not just in India for these products. And in India, in terms of modernization, in terms of quantities that is required, these 4 products are very less in India. So there is a huge domestic growth which is coming. Plus, there's also a global growth is coming. And Solar is the only private sector company that we found is completely aligned to these 4 particular products. So like they already have on the defense side, the 4,500 crore number which you mentioned, they already have in the order book Pinaka rocket, They are already executing drones, which is loitering munition Nagas taraf. Bhargavastra is a counter-drone system which they are in the final stage of getting approvals. And ammunition is a factory which they soon will be commencing with 155 cells. So that is something where we like the stock, though it is expensive.
Okay, and your target price is 21,290, so that's a good 17-18% upside. Is that your top bet right now in the entire defense pack? And talk to us about HAL, because I remember HAL, it came out with the numbers maybe a week back, but it was a disappointing set of numbers. And the company even missed the provisional guidance that they had given a month prior. So what exactly happened? And are you in a way sensing that execution has been lacking? Like even Mazgaon Dock, some of the orders got delayed. If you want to broadly comment on HAL and if we are seeing any delays in orders across the board.
So on the private defense side, solar industries remains to be a topic without any doubt. Specifically on Hindustan Aeronautics, so the revenue numbers were already out. So on revenue terms, they surprised positively. However, on margin, there was a little bit of a mess. But the negative part on the commentary came when the Tejas delivery was postponed to August-September as far as management is concerned. So that was looked a bit on a disappointment side. And so that was a major disappointment. So Tejas, they expected something to get delivered in FY26 at the start, but things did not turn out. Now in FY27, they are promising close to around 15 to 20 numbers of delivery in this financial year. So once the Tejas delivery starts, I think that's where you will see the stock will again go back to its original levels. And that's probably one of the reasons why we have upgraded Hindustan Aeronautics to buy at this point in time.
And the target price here is?
Target price here is 5,500 approximately.
Okay, got that. Any other stock that you recommend? Solar, HAL is upgraded. Any other? You used to like BEML also.
Yes, we still like BEML. So that comes under cap goods. So so BEML we still like. So this quarter is looking to be decent, but we think the second half of FY27 is where the real story of execution will play out for BEML. It has a very strong order book of 17,000 crores, out of which the major order book is coming from metro and rail. And large part of that is going to get executed in next 2.5 years. It is Bangalore Metro, Chennai Metro, and Mumbai Metro, all three put together. So that's where the revenue growth momentum is going to see. Addition, defense is going to continue, and there are some large tenders both on defense and on rail and metro side, which are likely to be announced in FY27, where one of the beneficiary would be BEML.
Harshit, there's two more areas. I don't know if you've you track shipbuilders morning. Anything you like there? Lots of action tie-ups with foreign governments for capabilities, etc. There, you've got a few listed.
Yeah, so we cover GRSC, but we are sell on GRSC because we think there's a peak in the cycle for GRSC. But if somebody has a long-term view, looking at the commercial shipbuilding, then this is the sector to be looked at. And in this particular space, we like Cochin Shipyard and then GRSC in that order. Cochin being it's part of the Ministry of Shipping, and if you look at the tie-ups which are happening, as you rightly pointed out, Cochin has been the front runner of these tie-ups. So a lot of commercial shipbuilding tenders are already out, and we see these are being largely awarded to specifically defense PSUs, and Cochin being one of the major ones here, followed by L&T and Swan on the private side of shipbuilding.
Thank you, Harshit, for joining in. Great conversation. We'll slip into a break. On the other side, Deven Choksi will join in for some fundamental stock talk. Stay tuned.
Welcome back. We got about 13 minutes to go for the pre-open session to kick off. We done 200 on the GIFT Nifty. That's the indicative open. Hormuz is here with the big movers yesterday and the volumes there as well. Hormuz, take it away.
Morning, Prashant. And of course, the one sector that has been keeping the market in check so far has been the IT sector. And it was the moves across the board yesterday, be it large cap IT or mid cap IT, Infosys, TCS, Coforge, all of them doing very well. And across the last 2 days now, all of them are up anywhere between 10 to 12%. And if you take a look at the options as well, yesterday, their call options were premiums were up anywhere between 60% for TCS to as high as 200% for Infosys and for Coforge as well for their most traded options. Now you take a look at the volumes, Infosys, and for all of these three names, the volumes in comparison to their 20-day average were anywhere between double or triple that average number. For TCS as well, same is the case for Coforge. Now for the delivery bit, Infosys had almost 70% of their total traded volumes marked for delivery yesterday, and that too was almost 3x higher than its 20-day average. For TCS, close to 55 lakh shares, the 20-day average is only 20 lakh shares, and for Coforge, just above its 20-day average, but was higher nonetheless. Now, a stock that has been declining over the last couple of days has been Jain Resource Recycling, and that's a recent listing. And the stock was down 18% on Monday, was down another 16 yesterday. There's a 2-day fall of around 32-33%. Now, if you take a look at the volumes as well, now in comparison to the average volumes of around 33 lakh, the volumes yesterday were around 2.5 crore shares, and in comparison to Monday too, the volumes were more than triple of what was traded on Monday. Now for both of these days, 26% of the total shares that have been traded were marked for delivery. Even in yesterday's session, 62 lakh shares were for delivery. The 20-day average is less than 9 lakh shares, so it's almost 7x compared to their 20-day average. And lastly, Apollo Micro, now that was one positive earnings reaction that we saw yesterday, the biggest single day gain in over a month. The stock is up in 4 out of the last 5 sessions. Volumes were the highest on record. There was over 11.5 crore shares traded. The 20-day average is only 1.2 crore, and 10% of those were marked for delivery. So around 1.2 crore shares were marked for delivery as well. The 20-day average is just over 31 lakh shares, and in fact Thursday's turnover was 85% of its free float market cap, which is just around 4,500 crore rupees, and it was the second most traded stock in the market yesterday. And from the March 30 lows, from where the markets also began the recovery, the stock is up almost 90%.
Oh, got it. Okay, all right. Thanks a lot, Hormuz, for joining in and giving us all of those details. Well, let's get in Devin Choksi, MD at DR Choksi FinServ, who joins us on the show. Hi, Devin. Good morning. Good to see you win. Let's focus on Hindalco. The stock has had a great run, right? I mean, from 700, 750 all the way to around 1,100 rupees odd, and it's pulled back a little bit. Now, the operational performance actually improved, but there are some one-offs there because they've got some insurance for the fire that was seen into 2024. They've also got that negatively hit because, of the fire and also the tariffs. Put everything together, operational performance is good. Problem is debt, net debt to EBITDA, moving up as well. What is your view on Hindalco at this 1,050 level?
Nigel, good morning. Well, I think no denial of the fact that overall the environment remains quite conducive for the metal commodity, in particular white metal commodity in particular. It remains quite conducive from the business perspective. On one side, we have got a firm commodity prices because of the demand traction that we are seeing from the consumer segments. Particularly, I think now the aluminum's major consumer segment is also emerging very strongly. Could be in the area of even the data centers and ultimately, I think, other industries, including the aviation, including the automobile. So from a perspective of looking at, I think, a large level of growth, the demand scenario likely to remain robust. On the other side, the captive power sources, I think, are emerging strongly. So that is where probably, I think, we are likely to see the drop in the cost of the energy, and that's what is going to be margin positive. So structurally, I guess the business is looking absolutely convincing. Maybe I think the stock prices have run up and probably they are fairly priced at this point of time. So one can't argue for buying fresh from in the portfolio. But being the commodity nature, if one gets the opportunity during the corrective phases in the market, would be a good upside move for 15-20% in a year time. Is distinctly possible from the lower levels.
Devin, just in terms of positioning right now overall, I mean, how are you? Are you looking for trades here? Trades, or I mean, investing is one, but what are you really doing? Or just sort of, in another context, Adrian Movat was with us in the morning. He was saying maybe cash is a good idea. Just watch. Or what's your sense? Incrementally, I'm saying, what you own, you own. Nobody goes all cash, but just incrementally. What's the thought process and positioning like?
Yes, Prashant. Good morning, and very valid point, I think, to answer for. The important aspect that we see in this particular quarter, some of the good quality companies are likely to get affected because of the adversity into the business, particularly on the input cost side and logistics side. And as a result of which, I think the market might possibly give an opportunity at lower levels in some of the good quality stocks. Maybe power ancillary sector, maybe banking sector, some of the large NBFCs. I think they are typically showing the character of giving you, I think, the advantage in form of lower price because of the overall condition in the marketplace. Should that happen, I think it's going to be a good buy opportunity. In my viewpoint, irrespective of, I think, whatever is happening around, if the valuation comes down and that is becoming an attractive opportunity, I would certainly think that I think buying would be more appropriate. So April to June quarter, maybe in July to September quarter would be the quarters in which I think one would like to consider on buying and building the portfolio at lower levels, particularly good quality stocks where the resilience is extremely high as far as I think the business opportunity is concerned and the profitability is concerned.
Got it. Devin, stay with us. For the time being, we take a short break. We come back. We'll continue our chat with Devin. Our technical experts are also waiting for us. Stay tuned.
Welcome back. There's 18 minutes to go for the market open to come up. Well, let's just put up the Nifty IT index from yesterday. There's 4 minutes to go for the pre-open as well, so you'll see the rate and how we left off. 3% higher, was up more, the Nifty IT index. And in the last two sessions this week, the Nifty IT index has gone up. It was 6%, is now 5%. But 5 is not bad. 5%, the index that is. And of course, Infosys, TCS, HCL Tech, Wipro, these were some of the largest gainers on the Nifty yesterday. And of course, in the broader market, Coforge went up sharply, KPIT, and the entire list, IT did very well. But this is, of course, after last week's brutal 6% fall that we had for the Nifty IT index. So there's a bunch of reasons we outlined yesterday. But Devin is with us with just his perspective on it and whether this is a bounce. We've seen bounces before and kind of, how to think about it. Stocks have come off the lows. Coforge fell to under 1,000 rupees. It's back at about 1,400 plus. I'm talking about the more like names, Coforge and Persistent, etc. But your thoughts, Devin?
I think excellent opportunities coming along as far as some of the good quality stocks are concerned, particularly in the mid-tier IT companies where they are typically, I think, using the AI as an enabler for delivering the project faster. In the process, I think, commanding relatively better margins also on every contract. I get to see, I probably, I think, also observe that in some of the large IT companies, under the discussion with the management, we find that their new contracts, that means their AI-enabled services that they are adding into, probably are delivering faster results to the customer, in turn, I think, better profits to the companies. So in my viewpoint, everything is in price. Today, the prices have come down. And I think opportunity is remaining, I think, as high as one would have think. On the contrary, I think opportunity is becoming much stronger. So probably, I think it's a contra-buy opportunity in some of the good quality frontline IT companies. Selective and gradually one should be in the portfolio of these loans.
Do you want to name some IT names?
So we continue to like the likes of Tata Technology, KPIT in the mid-tier space, and I think among the larger ones, TCS looks, I think, more convincing at this point of time.
Got that. So Hormus was just telling us about some stocks where there is a fair amount of momentum. IT, of course, was one, but Jain Resource Recycling. On Monday, it was down 18%. On Tuesday, it slipped close to about 16% and very, very large volumes. So, is there a view that you have on Gen Resource Recycling? And the other one is Apollo Microsystem, where the stock has been seeing a lot of upward momentum.
So, Lima, I think unfortunately don't have any view on this company. It's not having coverage either.
Okay, all right. Devin, let's talk about Grasim then. Grasim will be coming out with its set of numbers. Interesting set of numbers, not just because we look at, smaller part of their business, the VSF business and the chemicals business, but also the paints business. Is it gradually moving towards profitability? And is there some inorganic growth as well? Remember, most of its value comes in from Ultratech Cement. But what's your view on the name on Grasim added on this price of around 2,800 rupees odd?
Well, I think the key trigger would be coming in from the paint business. How soon, how fast I think this particular business is contributing into the books, I think is something which one will have to watch out for. So they have indicated in past that it's a long haul. It's not going to be so soon, so fast. But we would like to see whether the company is heading into the break-even plus kind of a situation. If that does happen, then certainly I think one can expect some amount of re-rating. Not completely sure about, I think, the volatility involved into the VSF and the chemical business at this point of time. Though the March-ended results are likely to be much better, but the fact remains that I think we are in the new quarter already, new financial year already, and that's where the volatility into the input cost, I think, is going to be affecting many companies, and that's what we would like to be watchful about it. So once I think management commentary is heard, probably I think that will be a better time to take further view on the businesses of the company.
State Bank of India continues to grind lower. If we could pull up a fortnightly chart on State Bank of India, it had one sharp sell-off post the numbers, but after that, the stock has been grinding lower. And now at about 930, pre-numbers, it was closer to 110. At what point, Devin, does SBI become a buy for you?
Yeah, I guess I think it's an opportunity which has already come along, and I think it should be an accumulation stage at this point of time. Any further fall due to the nervous market condition, I think would be a further buy opportunity. But as of now, I think one could accumulate the stock. We see the downside risk practically protected because of the valuations are far more comforting at this point of time. Even if one has to assume the higher amount of interest scenario, still we believe that I think everything is now factored into the price. So buying opportunity is strong, a large book at the same time, and I think higher amount of traction that is being seen. It is in the corporate borrowings, corporate lending by the bank. We believe that I think this is good opportunity probably which is coming along at the current price.
That tells you the thing, right? I mean, we put out a flash saying we've hit a record low at 96.86 and the record low is 96.88. So the direction of travel has been down south. And I was saying this, the move in US yields in the last 3-4, actually it's not, I mean, it's yesterday, but it's also, we saw a big move a few days earlier as well. It's coming at the wrong time because it makes, what we need is, of course, dollars, more dollars in, and dollars become more expensive as US rates reprice higher. That's problematic in that sense. So almost 96.90 now on the rupee coming through. Maybe to get a perspective from a rupee market participant, if you're able to get just a quick word in, but this is not looking all that great. 96.88, 96.88.75 or so at this stage. We had Ramdev Agarwal yesterday talking about the currency, the rupee, and the oil conundrum as well. So if we have that lined up, just like to play it for you right now, and then we'll come back with a view.
We have, as you said, worst performing currency from Asia right now, but India unfortunately is hit from two sides. One, the energy artificially prices have just shot up by 70-80% from $60 to $110. So that's putting a lot of pressure on the current account. Second is that on top of it is the FI outflow, because for two reasons. One, we don't have AI story. In fact, we have anti-AI kind of situation in India. And of course, we have a pressure on the currency. So, and that is exerting further pressure on the rupee because there is a sustained selling of almost $500 million every day from FI sides. So, twin effect of high oil energy prices and FI outflow is putting pressure on the currency, which the regulators are finding, the banks are finding, or central bank is finding it difficult to handle at this juncture. They are allowing the free flow of the currency till the crisis is over. We have been seeing very sustained outflow out of India. One, of course, because of the very strong local buying, which is going to become even bigger as we go forward. So the government, the policymakers, they have to think in the backdrop of very strong local buying, how do we console? And my local buying is decadal in the sense that next 20 years, 25 years will become even bigger. In that backdrop, what do I do for the FIIs or FPIs so that they have a little more positive view of India? They might be having some small demand about capital gains tax. Worldwide it is not being charged. Why we are being taxed out here? Why we are being charged capital gains tax? So whatever their demands are, I think the authorities should look at it very intensely, because it's a very changed environment.
Yeah. That's Ramdev Agarwal and Motilal Oswal with some perspective on, I mean, it's all linked, right? I mean, oil is linked, rupee is linked, capital outflow is the problem, the capital account is the problem. And that sustained outflow is what Ramdev Agarwal was talking about. 96.8850 or so is where we are at right now in terms of the currency level. Devin is with us. Devin, we did talk about market positioning, but in terms of, are the equity folk expecting anything, any action? I mean, the perennial ask, of course, is do something on equity taxation and that kind of thing. But we had yesterday two economists from ICICI Bank and Kotak Mahindra Bank who said, well, the bar for doing something on equity taxation is very high, very unlikely. But there is other stuff which is getting discussed. From the equity market point of view, anything being discussed or any chatter out there?
I think the couple of points here, maybe the taxation and other aspects, I think may have its own short-lived outcome as I see it. But more importantly, I think something to do with fixing the derivative market. Derivative market has been, I think, at the root cause of the problem as I see it. Significantly large amount of volume is basically pushing the underlying equity prices significantly in an adverse situation like this. I think the views like pegging the derivative market exposure to underlying equity portfolio should be the ideal approach. I think that one can possibly talk about, I think, to the regulators. Should that happen, then quite possible that on one side, I think they'll start building the underlying equity portfolio while taking the exposure on the derivative side. Today, the exposure on the derivative side is being taken, I think, with other collaterals. I think that's where probably, I think, the larger problem is. And that is also probably the root cause of, I think, the currency-related situation. That frequent flight is taking place of the currency. So in my viewpoint, I think this problem has to be fixed. Maybe I think we have allowed too much of derivative volume in our marketplace, which requires, I think, some amount of immediate attention, particularly in a situation like this when currency has fallen so badly.
Yeah, absolutely. Devin, I just want to get a couple of technical calls out of the way as well. We are 96.91, so the pressure is kind of one way, and this is what the risk is, which is weakness feeds into more weakness. It kind of becomes a self-fulfilling prophecy. So while yes, I mean a weak rupee helps cushion some of the blow and balances the imbalance, helps exports and all of that stuff, but you got to watch it as both our economists yesterday pointed out. 96.94. So this is moving. If you have the intraday so far, it's only just been, 8 minutes or so, you'll see what I'm talking about. We started at 96.86 and we're already within the opening few minutes of the rupee market open at 96.9350 or so. So 96.94, I guess, is the new level, the new low the rupee has hit right now. So how fast those handles are changing, 95, 96, now you're at 97 in just a couple of minutes, a couple of days, basically. Well, Mitesh is with us, and so is Sudarshan with quick trades at 9:10. Mitesh, anything? What's on your radar?
Given the fact that the GIFT Nifty is indicating a lower start, we'll have more of sell calls. I have a sell on Gas Authority of India Limited. Keep a stop at 159.5. Look for targets of around 150. Then DMart is revenue supermarkets that's also on the sell side. Keep a stop at 42.80. Look for targets of around 41.70. One buy call, that's Bharti Airtel. That's a buy with a stop below levels of 1890 for targets of around 1955, 1960 on the upside. And the final sell call is Astral. Astral kind of broke down yesterday, so that's a sell with a stop at about 1500 for targets of 1350.
Sudarshan, your 9-10 calls?
Yeah, the Nifty had a narrow range day yesterday. So it's breaking down. There's a trade on the short side for intraday traders. That's for the Nifty. United Spirits is my only buy with a stop on 1215. SRF is a short with a stop above 2685. Tata Steel is a short with a stop above 215. And Nuvama is a short with a stop above 1490.
Got it. Okay, all right. Thanks a lot for that, gentlemen. Let's focus on a couple of top stocks. First, Hindalco is in focus. The stock is opening up on the back foot. Maybe it could be a market sentiment or it could be a couple of factors like the higher debt that are being on. But otherwise, the results for Novelis have improved. Better scrap spreads definitely aided them. Though the total shipments, they were down by close to 12%. That was expected because the Oswego unit, it was impacted by the fire. The adjusted EBITDA, though, that came in at around $459 million, with the adjusted EBITDA per ton coming at around $544 per ton. It was impacted, remember, by negative $53 million from the Oswego fires and $27 million due to the tariffs. But it's offset because they got around $41 million from the flood insurance recoveries that was experienced in 2024. But there are two problems. One, the fire impact is now talking about a total impact on the free cash flows at around $1.7 billion. Earlier, they were talking about $1.3 to $1.6 billion. And the second factor is the net debt to EBITDA. That's risen to the 23-quarter high of around 4.1. So that's a bit of a worry. On the plant-specific action, they're talking about the New York plant restarting in a few weeks. That's sooner than what they spoke about earlier, which is good. And they've also said the full commissioning of the Bay Minette unit remains on track by the end of this calendar year. On guidance, they also said that they'll be returning to free cash flow positive position by the end of this fiscal. Net, operational beat, some glitches in terms of the net debt number. For the time being, the stock opens up a little bit in the red. But the one that's taking a harder knock is PI Industries. Ria joins us to help us out with a quick analysis on that one.
Well, yes, it has been quite a weak quarter for PI Industries this time around. Below estimates on all fronts, and the street was expecting a weak quarter versus a relatively difficult year-ago base for the company. Revenue has declined by around 12% in quarter 4, in line with the estimates that the street was working with. But EBITDA has declined by 26% versus estimates of just a 19% decline. And net profit has also tanked by around 39% compared to estimates of a 23% decline for quarter 4. And margins have contracted by nearly 400 basis points to just 21.5% versus estimates of 23% margins. Even if you look at the full year performance for the company, that has also been quite weak this time around. Revenue and EBITDA declining in line with estimates, and the net profit, the adjusted net profit, also down by nearly 27%, and margins have contracted by 200 basis points to around 25%. But this is in line with the guidance that the company had given, and they have said that a favorable product mix this time around has supported margins for the full year. In terms of the segments, the agrichem exports have declined by nearly 19% compared to the previous year, with volumes declining by around 14% due to a high base effect. Domestic revenue also saw a decline of nearly 7% compared to the previous year, with volumes going down by 1%, although the pharma revenue has been strong, growing by around 40% compared on a year-on-year basis, and this contributes roughly 6% to the export revenues for the full year of FY26. But overall, it has been a weak quarter and a weak year for PI Industries.
Okay, let's put G Vernova as well. I think there was an analyst call yesterday, and some commentary coming through on that one. Stocks up about 1.5%. So, I mean, stands out when on a red screen, there's some green as well. We've got first rates, which will come up in just a bit from now. We can just maybe put up, some of the stocks we'd highlighted from the morning, just about 60 seconds to go for the market open to come up. It's a broad kind of macro down move with the bond yields higher and the US equities a little lower. Rupee, of course, making fresh lows. Yeah, so it's a tough spot in that sense. BB is down about 1.5%. Of course, reported numbers. Mankind reported numbers. There's a bit of a miss there, about 1/3% higher. HCG was another one, which Ekta had highlighted. Hutco and so on and so forth this morning, which will come up. PI Industries, which just highlighted. Orkla India, fairly recent listing. Z is the other one. So first rates will come up 160 odd points lower. Is the pre-open session, and we'll start somewhere around there. 23,450 on the Nifty, 23,400 on the Nifty. So about 0.8, 0.9 lower. Bank Nifty is down about 0.25%. Should not be a quarter, should be more. 1% lower, I think, on the Nifty Bank. Yes, it's down about 0.9. Mid-cap index is down 0.8. The small-cap index, I think, is also starting in line with what's happening in the broader other indices. So 1,260 stocks are lower and about 550 stocks are higher. So it is a little over 2:1, declines to advances to begin this Wednesday morning. The heat map should be, all red, mostly all red, except Hindalco. Nigel's Hindalco is the only green today, so holding up. On the other side, I mean, it's like BEL and Tata Steel and Nestle and Eternal and Grasim and others, which are all starting with some amount of pressure. We're down 190 on the Nifty. Rima.
Well, no place to hide this morning. It's 23,400. The sentiment has been hit on account of the persistent weakness in the Indian rupee and elevated crude prices, now closer to $111 per barrel. The top loser on the Nifty is Tata Steel with a cut of more than 2.5%. BEL is now hovering around its 200-day moving average, 1.7% down on BEL. Numbers were steady, but stock is under pressure. You can see weakness in consumer names, so Eternal, Nestle under pressure, auto names like Eicher Motors, Maruti Suzuki, so two-wheelers, four-wheelers, weak in trade. SBI has lost close to about 1.5%. Bajaj Finance is under pressure this morning. M&M is another one in the auto pack where you are seeing softness. The Nifty Bank is underperforming today, and the problem is not just State Bank of India, it's ICICI Bank and Kotak Mahindra Bank, and both these stocks are sliding close to about 1.5%. Now on the way up, well, Hindalco is right on top, 1.5%, but TCS, Wipro and Infosys are flirting with the flat line. TCS for now is holding up in the green. Infi and Wipro are still trying to make up their mind. But it's all red, down 0.7%, and look at the advanced decline ratio. We've got about 700 stocks in BSE advancing for more than 1,500 stocks declining. So you've got an advanced decline ratio well in favor of the stocks declining. So the mood is somber.
Well, that's right, Rima. There are a few stocks, though, though they have the headline index that's down, and that rupee is a big worry out there. Moving to a 97 odd, you want that level to get defended. But let me try to pull up some of those winners. Godavari Power and Ispat, the stock opened up higher, but market sentiment is weak. And it's already a 19-20,000 crore market capitalization company. But otherwise, those numbers look good. Record revenue, record EBITDA as well. Stock's still holding with a gain of around 2%. The other one is Jai Bharat Maruti. It's a smaller name, but it's coming up as one of the top volume movers in today's trading session. It's only a 1,100 crore market capitalization company, by the way, Jai Bharat Maruti, but locked in upper circuit. The reason is that the margins have now scaled to approximately that 12% odd mark. A few quarters ago, if I look at the chart, it was doing around 6 to around 9% of margins. So the street likes that with revenue at around 770 crores. So thumbs up out there. Karnataka Bank, that's another stock that's done pretty well in today's trading session. It's reacting to its numbers, big green tick on that one. Also pull up dredging. The stock is up close to 22% in this week, putting together even the 5% gain today. So the street clearly likes those numbers that they have delivered, and that one is up and about in today's trading session. So those are a few winners in trade today. What's losing out? Shaily Engineering down close to around 6%. Nefrocare, that stock is down close to around 6%, so big downtake out there. And Borosil Renewables as well, down close to around 5%. Net, the number of stocks advancing are close to around 500. Individual stocks doing a thing of their own, try to name a few of those winners. The breadth of the market negative, but hopefully it pulls back from here.
Well, let's PI down about 8%, right? That's a big one, which is coming through at this stage. Well, let's bring in Sanjay Parekh, who's with us. Markets are starting lower, as was expected. Sanjay is founder and CIO of Soham Asset Managers. Sanjay, it's always great to see a smiling face a smile gets out a smile. So, but you know, it's a tough situation, and they say, well, out of despair comes opportunities, etc. I'm not sure we're at that stage with the prices and what the corrections and all of that, right? Because the economic damage perhaps is real. Next 2 quarters, there will be margin pressure and so on and so forth.
Yeah.
But in any case, I know that you are busy with stuff which is sort of, not unaffected, but fundamentally strong, and you continue to focus on those things. I mean, some thematic, but more single stocks across the board. So just run us through what you've been doing.
Good morning, Prashant, Nigel, and the team. So, what we've done is, clearly moved up to large cap, and anyway, our product has large cap mandate. But we moved from 72 to 83% in large cap. Second is, while we can never, protect capital when in a fall, but we just said that can we try to insulate ourselves? And we were happy that from Jan fall till now, market has fallen 9%, we have fallen 3%, a little more than 3%. So the third thing is we said, okay, let's look for larger cap leaders, who are in a real dominating situation and can do better in a tough environment. So right from, Mr. Mittal in Bharti or Reliance or Adani Group, we have few stocks, or JSW Energy, or DLF, or Samvardhan Motherson, or Maruti, Mahindra, Bajaj Finance. These are the large holdings, and they can navigate in this journey, and it will also impact them, but it certainly will be better off. When the things do get over, you are in a far better shape. And also the larger banks, or even Zomato, which is a leader in its space. So that is our strategy, and by and large, it's worked for us, that being large cap, with leaders who can navigate this scenario and take us through this with the least damage.
Sanjay, hi. Morning. What about exporters? With the INR now at 97, are you looking at any export-oriented themes very closely? If yes, which stocks are a part of your portfolio?
Right. So after the acquisition, and just when the Sun Pharma's acquisition was announced, we were apprehensive. But when we really heard them out, we felt very, very positive. So in pharma, we've moved mild overweight with Sun Pharma at a large weight now. This is exactly after the call we added, because we really found it very, very reasonable and accretive without any dilution, and we didn't see a financial risk. So when we understood the acquisition, we really felt it is a good positive, and that is where we are pharma overweight with the inclusion of Sun Pharma. So that's where we are. Overall, otherwise, we're not tilted to exporters, because IT, as you know, is going to be more like what is a volume growth rate. And rupee will have some positive, but I don't think, meaningfully you can see significant appreciation because of rupee depreciation. It's always followed volume growth rate, dollar revenue volume growth rate. So that's where we are. We are still underweight there. And then we added a renewable space again, a little small, in a small way, Vari Energies. The near term can be a little uncertain, but longer term opportunity is where we think we are, that could be a good thing. So that is where a small addition we have done.
Absolutely. There is a large fundraise afoot, right, Sanjay? There, perhaps.
Yeah, and also near term can be a little challenging. So we started in a small way, but the long term opportunity is pretty good. They have a huge ambition of moving up to 1 lakh crore. That looks quite ambitious, but I think they have a right to win. They have got already around 6,000 crore EBITDA. They're targeting the assumption, the projection they have is around 7 to 7,500. But in 3 years from now, we were just looking at it. Can it become more like 12,000-13,000 crore EBITDA company, or maybe more? And we thought that, it is. So it has a critical mass size. It's still it's classified as mid cap. So that's where we are. And globally, Chinese peers cannot be compared, because we are going to be protected for a while. And that's been a government stand. So that's where we are comfortable on valuation.
Sanjay, many believe that the earnings growth in the mid and small caps is going to be a lot more than large caps. The large cap growth could be more muted. So don't you think that is good enough to bet on small and mid caps? Or do you think because of the crisis, the elevated oil prices, the earnings growth that the street was expecting from mid and small caps is not going to play out?
Yeah, Lima, so there, see, first, these larger caps are really, so for us, it's not that they have to be leaders, they also have to be reasonably valued. So all the 16, 17 names in larger caps as a basket are like really reasonable. Our average price earning of the portfolio is 14 times on FY28. So first is where we look for reasonable growth at reasonable price in the larger cap space. In mid and small cap, the problem is, you have good names, but at twice or thrice the valuation. So there you need to dig hard. We are very, very open and we will increase our mid and small cap exposure, but at higher price value cap. And certainly we need to give, some of them can get knocked off or get really badly affected. So which are the ones which can navigate in this cycle? We certainly will look at it, but at our valuation.
Is IT a valuation issue for you, Sanjay, or it's a more business model and that kind of issue?
I think it's a growth issue. I think the longer term growth is derailed. So you could have few companies who could be benefiting. You will see volatility. You could see dead cat bounces, but we don't want to be overweight. I mean, we don't want to even cut our underweight right now. Because of rupee, they will benefit. You could see a bounce. But I think secularly, the guidance itself is suggesting lower growth rate. So it's not about us. You see the guidance given by the large, and we own it, right? So we own Infosys. But I think we will continue to remain underweight. And we don't want to preempt this AI-led contraction in revenues.
We were just chatting with Adrian Movat earlier in the morning, and he was talking about, well, the new trade is nacho, not a chance that Strait of Hormuz opens up. And this term has been there now. It's been gaining traction for the last 1 month, and the war itself is now in its 12th week. How much more pain do you think the markets have to endure? Even you said, while you relatively perform better than the downfall we've seen in the market, it's still a contraction in terms of returns. What is your own assessment for the pain? How long will we continue to just grind in this way?
Well, we really think hard on this. So let's start. First, if we did not have a war, our markets would have been 26,500 for sure. But we have this. So we have almost $500 billion knocked off on aggregate market cap. And for a pain, maybe around $60 billion, if that lasts for the whole year. Right? If we take broadly 5 million barrels into the maths that you all only did it so well. So $60 to $65 billion is the pain purely because of the crude. And then you could have add-on escalation. So there is a lot of damage that has already happened in market cap. And as I said, this has to last for the whole year. And then, of course, the cost of equity has gone up, rupee depreciates. So it's not so simplistic. But I really believe that in the next 3 to 5%, there could be pain, but it will throw up a phenomenal opportunity as a contra. And that's why what we are doing is we are slowly telling clients to accumulate. But with a weak Q1 and with rupee, what it is doing, we can get into a little bit of vicious cycle in the near term, which could be a 3 to 5% fall. That is possible.
Yeah, got that. We'll keep fingers crossed and hope for the best. I mean, you got to stay optimistic in terms of what happens. Be careful, be cautious, and all of that. But of course, stay optimistic that better things will happen. Thanks very much, Sanjay. Appreciate you joining us on the program and talking to us here on CNBC-TV18. Well, I think what we're going to do is talk about the insurance sector now. And here is a voice right from the top of the sector. We kicked off our 5-episode series, Insuring Lives, Securing India, Insurance for All, which CNBC-TV18 and Kotak Life Insurance are presenting together. The first guest who's really kicked this off for us was none other than the IRDAI chairman, Mr. Ajay Seth himself. The IRDAI chairman touched upon lots of hot-button issues. Let's start with insurance distribution reforms, which the industry is keenly awaiting. on the distribution side, what we understand is that there is. I mean, you are working on a consultation paper, which is going to be comprehensive in its scope. As you said, you will travel with the industry in the sense that you will take feedback and then, of course, come up with what is to be done. Is that understanding correct?
That's correct. We expect that in about 3 weeks or maximum 4 weeks, we should be out with the discussion paper.
And it's going to be comprehensive and.
What we propose to do is present a good analysis of the sector as it is now, provide some sort of a framework where the distribution reform should travel, and then elicit feedback from the industry and the public at large.
The public insurance registry is being seen as a Sibyl moment for the insurance industry. Here is the IRDAI chairman, Mr. Ajay Seth, talking about what it can do, what's the aim of the PIR for the sector.
Public insurance registry. And the way we are conceptualizing it, and we are again aiming for that by mid-June, the discussion paper is out. It is a digital public infrastructure for insurance industry. We have put it rightly that what the Credit Information Bureau did for the credit market, or somewhat what the depositories and the stock exchange, electronic exchange did for the capital markets. Of course, PIR is not an exchange per se, but is a data infrastructure. The concept is not only between insurer and the regulator. First, of course, it will help a big way in the mis-selling, preventing mis-selling. It will also make a business sense for an insurer that how to underwrite better and how to prevent fraud. And for distributor, while margins may be lower, but it should mean more business.
Absolutely.
And if all three are happy, regulator is naturally happy.
Well, the IRDAI chairman also told us what he wants to achieve with Bima Sugam, substantially cheaper insurance products for customers. I mean, that was the big headline.
Bima Sugam is a platform which is co-owned by all insurers, regulated by IRDAI. This is not a platform of distributors. Two fundamental differences. At the moment, irrespective of the distribution channel, price of a product or return of a product is uniform, irrespective of what the cost of that distribution channel is. Bima Sugam seeks to do it differently because it's co-owned by insurers, the least cost, but same quality or even a better quality. Second, present products in a standard manner, but with substantive value, so that the people can buy themselves. That's the second element which brings in. So moving forward, we see it that as the first phase, starting with term life, maybe ULIP. ULIP is generally considered to be a complex product, but people in this country have learned very well what the mutual fund means. So ULIP in 2026 is not a complex product, it's a simple product. Then moving on to other life insurance product later on, but on a general insurance, it's starting with motor insurance and also for a health product. So that is what it means. So better product discovery, better price discovery, where insurers compete on their performance rather than letting the distribution channels compete or push products where they get higher commission. So I see it here that Bima Sugam can be a transformative intervention in terms of getting value for the customers.
What would IRDAI's role be? As you said, I mean, regulated by the IRDAI, but owned by insurers. So where does IRDAI come in with regards to the architecture you set? But in terms of, I mean, you know, where would you step in on an operational level?
See, IRDAI's role first is nudging everybody to come to a common platform. I'm saying that instead of competing on cost, compete on your performance. And this platform should provide standard products with good quality and at the most competitive price. So it's getting everybody together because growth of the industry to meet the economic needs or needs of the large population which we have got is possible only when there are standard products.
If I can just close the loop on Bima Sugam, do you imagine that the pricing on products on this platform, Bima Sugam, compared to others where consumers transact now, etc., through various channels, but there are other online channels, etc., there would be a substantial price difference?
No, first of all, this is what we hear from the insurers and from the public. Today, some of the distribution channels dictate terms saying that you shall not sell, an insurance will not sell a product at a lesser price on any other channel, which is anti-competition. So there has to be a pricing flexibility has to be available to each insurer based on the cost. And that's the difference. We can walk into a mall, buy a product, it will be differently priced. We can go to an e-commerce platform and buy the same product with the same quality at a discount. So the choice has to be with the customer.
So that's a yes, sir.
Yes, of course.
The answer. So substantially, there will be a meaningful difference. That's the aim, at least.
That is what the purpose is.
That is what the purpose is. We'll catch the full conversation soon on CNBC-TV18. The IRDA chairman, exclusive right here. The program is called as a 5-part series, Ensuring Life, Securing India, Insurance for All. It's co-presented by CNBC-TV18 and Kotak Life Insurance. Okay, well, let's talk about this, right? And Nilesh Sathe is someone who's been part of the regulatory body, former member IRDAI, long-time watcher of regulatory environment in terms of how things have evolved. Mr. Sathe, it's good to have you with us here. So you heard it, you heard the chairman. What stood out to you?
No, good initiatives, I will say. Only one thing which I did not understand is why there are going to be only standard products on Bima Sugam. There should be all products available on Bima Sugam. This is one thing. Second is distributors dictating insurance companies that you should not pay more to anybody else other than what you are paying to me is something which is not heard of. It is heard of in mutual fund. In AMCs, there are national distributors who dictate like that. And we know that the smaller distributors, IFAs as are called, the national distributors say that whatever business is booked through us by the IFAs, you should not pay them more than some percentage which you are paying to us. This has happened in mutual fund, but not in insurance, unheard of. But maybe he might have some additional information on that. Bima Sugam is a good platform, no doubt about it. And it may be a game changer, provided the IT infrastructure is robust. Even today, not many buy insurance going online. Every insurance company has got digital online platforms which are available, but the experience is not so encouraging. The experience of Bima Sugam should not only be encouraging, but it should be different than what the present insurance companies are offering to the clients. If at all there is some technical glitch in going through seamlessly, let us understand who is going to be the customer for Bima Sugam. Mostly the youngsters. And the youngsters do not have patience. If at all at some point of time they find why I'm spending so much of time, the page is not moving to the next page, they give up and they will not come back again. So this has to be ensured by the owners of the platform, maybe IRDA and the insurance companies, to ensure that the IT platform has to be robust and there should not be any glitch while surfing is being done by the youngsters. Because see, if at all they do not buy online, people of 60s and 70s are definitely not going to venture into it. Initially, at least.
Yeah.
So
got it. Now, Mr. Sathe, the aim from what I could take out, right? And we've heard it from the government also. We've heard it from the top finance ministry. Really, I mean, the focus is that we want penetration to go up. And I think the IRDAI seems to be working lock in step with that aim, which is insurance for all by 2047, right? That's the aim. Increase penetration. And penetration essentially, one number which was floating around is the penetration is about, what, 15%? If you look at everything?
Oh, no. It's much less than that.
Yeah. No, I'm saying if you look at new to insurance, right, as a concept. So I'm just saying that and one way to do it is pricing, and I think that came out very clearly with regards to what the chairman spoke about with regards to distribution, Bima Sugam, and of course even the industry. Mr. Sathe, you would agree?
Yeah, I agree. If there is a substantial price difference between when you buy a product online and offline, then it's a great incentive for public to go online. No doubt about it. But to what extent it is going to be differential, that is also to be seen. If it is going to be 5%, 10%, then probably nobody would venture into it, because all said and done, insurance is a push product and somebody should be there to handhold when you are going through the buying process of insurance and also at the time of claims. So we have seen, in mutual fund also there are online platforms. But even today, not more than 8%, 9% mutual fund investments are coming through those platforms.
Yeah.
And insurance is more difficult to buy than mutual fund. You really need somebody to handhold. So I'm not worried about it. It's a good, you should have more options available.
Yeah.
Who likes to buy online? Okay, let them buy online.
Yeah.
Beyond that.
No, absolutely. Point taken. So we spoke of three things, right? The consultation paper, distribution reforms, the information registry, Bima Sugam. And there are, by the way, other things also in that interview which will be played out in full later when that episode airs, which is lined up beyond this. So, I mean, it looks like we are setting the roadmap for much of this to happen. I mean, the industry will, of course, have to work along with the regulator to make this happen, but the architecture is being set, and maybe much changed from how it was operating earlier. Would you agree, Mr. Sathe?
Yeah, absolutely. But then, for increasing the penetration, group platform is better, because like PMJJBY and PMSBY schemes, which are there, which are operated only through banks, actually, they are not promoted much. Nobody makes any efforts to promote it. And insurance companies have no role to play. It is for the banks to promote it. And crores of people can join through this platform directly or indirectly. So this is something which is easy to increase the penetration.
Absolutely. Absolutely. Got that, Mr. Sathe. We'll leave it there. We will talk more as that distribution paper, the consultation paper on distribution reforms starts to appear. As the chairman said, in 3 to 4 weeks, we will have that. I mean, of course, it's a consultation paper, so it gets feedback, discussions, and open to the public, etc. And then the rules will be framed.
Normally, it takes 6 months to actually
finally finalize. Yeah, absolutely. Yeah. Thank you very much, sir, for joining us, and really appreciate it. Thank you. What we'll do is we'll take a quick commercial break here. We'll connect with Pranjal Bhandari of HSBC and the impact of geopolitical tensions in the Indian economy. Rupee, of course, is a focal point, but much more on the other side. Welcome back. I think markets have recovered, and that's a good thing. From the lows, we've come up, and I think there's been a bit of a pushback on the rupee as well. From the lows of about 96, 96, 97 or so, the currency has come up, and from the opening lows on the Nifty, we've come up quite a bit as well. Down about 0.42. I mean, that's like a normal day, and not a 200-point cut that we were looking at right at the open. Pranjal Bhandari is with us, Chief India Economist, strategist, ASEAN economist at HSBC, and she's with us here in our studios. Pranjal, glad you could make it here. Thank you very much for joining us.
Great to be here.
It's just the talk of town in terms of what can happen, what will happen, because there is some firefighting arguably which is needed. What will be the shape, form of that firefighting is the question. So how are you thinking about it?
Yeah, sure. So look, it's all about external balances. You know, we're going to be running a very big external BOP deficit this year of about $65 billion. Sort of never seen this kind of a big deficit. And that's what's really showing up on the currency. And what's not helping over the last couple of days is that there is a bond sell-off globally. And whenever we see that, you know, we saw that in 2022, 2023, it's not great for flows into EMs. In fact, you start seeing outflows from EMs. So you already had this energy shock. Now you have a bond sell-off globally. So all of this is coming together. It's not great for the currency. Now, whatever we do on the currency, it should be something that's not just for the short term, it's also for the medium term. Because this is a problem that has been with us for the last 2-3 years. I think continue to allow the currency to depreciate a little bit. Trickle depreciation, not a sharp depreciation. So use FX reserves to soften the pace. Increase pump prices of oil and diesel as much as you can, because back in 2022, when we increased it by 10 rupees a litre, we saved $20 billion over the next year. I think that's very important money for us. All of the trade agreements you finalized with EU, UK, have it to work. Get all that FDI money to come in. I think that will be very important. I think these are things that should continue. Everything else has to be thought about a lot more clearly because there will be trade-offs. Things like FCNR, things like a quasi-government bond issuance is something you have to repay in 2 to 3 years. Are you sure you'll get that money back at that point to repay? Because if not, you're just kicking the can down the road.
And also the money is expensive now.
The money is expensive, of course. So everything else will have some unintended consequences as well. So if I were sort of making the policy right now, I would wait on for like maybe a month. Continue with what I'm doing, little bit of depreciation, oil price increase, pump price increase, and hope for the Hormuz to open by about 15th June or something. If that happens, I think we'll see a 1 to 2% step appreciation in the currency, which will help us. If not, then I think about all of these other big measures like FCNR, which are not clear-cut, but maybe we need something emergency.
You know, you said we'll allow the rupee to depreciate. That's the first thing you said, and in a trickle kind of a way. What we've seen so far, would you say it's been rapid, orderly?
I think so. I think we've sort of been doing like about 80 paisa to 1 rupee every 10 days in the last couple of months. I would say this is trickle. I think we needed this. We're doing it.
Okay.
It's been about 6% since the war started. It doesn't feel like a trickle, if you just think about it.
And that's because the war is so long. So
12 weeks now and counting. What about on the inflation side? Have your consumer inflation expectations gone up because pump prices are going up, and plus coupled with the fact that we've got a very hot summer and a likely weak monsoon. So that's going to compound the problem on the inflation side. And because the war has gone on for so long, are you bringing down your growth expectations? So just give us before the war, inflation and growth, and now what it stands at. And what's the risk if the war lingers on, say, beyond 15th of June?
Yeah, that's right. So right now our house view is that, Hormuz opens around the 15th of June, but it opens gradually. So it fully becomes functional by only end September. And even then we have dollar averaging 95 a barrel. So imagine that gets postponed a little bit. June becomes August. I think average oil can easily be $100 a barrel. So those are the kind of numbers we are working with. My sense is CPI inflation can average 5.6% this year. From September onwards, for 9 months, I think it'll cross 6%. And that's why I think towards the end of the year, we'll see rate hikes, maybe in the December quarter, and then again in the March quarter, I'm penciling in 2 rate hikes. The inflation increase is because of energy shock, but also because of an El Nino. And that's something we're going to be starting to talk about a lot more in the next couple of weeks, because if it sets in, this time it's likely to be a super El Nino. And it's not just about rains. I think we think too much about rains. The bigger problem is temperatures and heat waves. Every time we have a heat wave for even 10 days, we feel the repercussion for the next 6 months. Because for rains, we have irrigation facility to help us if there's a bad rain season. For temperatures and heat waves, there's no magic wand out there. So that's the part I'm worrying about at this point of time. I really do include a normal El Nino in my forecast, and I have a 5.6% number.
And on growth?
On growth, we grew about 7.5% last year. For this year, I have it at 6%.
Okay.
So I do think in a few quarters, it'll fall pretty sharply.
Okay, but so inflation expectations have gone up 6% by the end of the year. Growth has come down to 6%. So it's a tough balancing act for the RBI, but yet you're going to go with the fact that we're going to see 2 rate hikes before FY27 comes to an end.
That's correct. A lot of people ask me, why not more rate hikes? The OIS curve is actually pricing in close to 6 rate hikes at this point of time. But my sense is not more rate hikes, simply because even growth will fall a lot. So the RBI will have to be sensitive to growth as well. And when I go back and see El Nino years in the past, actually RBI doesn't really do aggressive rate hikes because it has to take care of growth as well.
All right. Hi, Pranjal. Good to have you in the studio. The last 3 months or so when we have spoken, you've pulled down your growth estimates from 7% to around 6.3%, and now you're talking about probably a number of 6% or sub that. What is the Brent crude prices you're factoring into these calculations?
Yeah, so it's about $95 a barrel for this year, about $85 a barrel for next year.
All right. Okay. Now, you spoke about various measures that can be taken, like, going ahead, increasing the pump prices as well, which could bring some kind of relief because the government doesn't take the hit then, and then it slows down the economy a little bit. I wanted to ask you, what about gold? One school of thought is gold imports are 70 to around $100 billion, very, very approximately. You could give me the exact number out there. Maybe go a little bit, harder at this. They've increased the import duty to around 15%. Maybe go the whole hog, because that doesn't impact anything directly. And that could be a temporary measure where you hike the import duty on gold and then, in fact, you see things shape up pretty better. Do you agree with that? Or would you think, no, that's too harsh a move?
I feel oil price increase will get us more bang for the buck than all of these measures on gold. And I'll tell you why.
Yes.
Every time we increase import tariffs on gold, it goes into the smuggling channel. Yes. There are many, many ways to get around it. And the system knows how to work around it a lot. So you just basically increase smuggling and all of that. In 2022, we increased gold import tariffs. The gold imports fell, but all other imports rose sharply. I think some invoicing, misinvoicing and all of that was happening. And I see that all the time with gold. So I'm not sure how much it will help. But oil, I must say, it does help. Because as soon as pump prices increase, everybody becomes a little careful. They start doing carpooling or whatever. And we always see our oil imports fall. So I'm a bigger fan of oil than of gold.
Let the gold, not let the gold come in, but use less oil. And that's perhaps the way to do it. Pranjal, just on the point of, there are lots of measures being discussed, right? One is the equity guys always say reduce equity capital gains taxation. And that's the big signaling effect. Even if you do withholding tax, 5 went to 20 on bonds and 20 goes to 5. The amount of bonds owned by foreign investors is not that large, right? $35 billion. So will that really make a big difference? But with regards to equity taxation, and the signaling could be large. But is it possible? What are the numbers in terms of revenues, the current revenue shortfall, and is it feasible?
Yeah, I think the revenue department will have to consider it very closely because it has been an important driver of revenue collection and fiscal consolidation over the last couple of years. My sense is that we've been collecting capital gains tax of about north of like 1 trillion rupees a year at this point of time. So that's a lot of money that you will be getting rid of. I would agree from a market deepening perspective, some cut in taxes for equity and bond market will be great for inflows over the medium term. But at the end of the day, you also have a fiscal target to meet. So I'm not really sure if the government officials will be very keen to cut all of these taxes. And then there are lots of other issues as well. You don't want to do it only for foreigners. Then there'll be pressure to do it for domestics as well. And as soon as that comes in, then it's a lot of revenue loss.
So you're saying the bar to do that, and that's basically been the view from others as we spoke about, is quite high. You'd imagine that that's not...
Capital gains tax, I think the bar is high. Maybe there can be something extra on the tax on fixed income investment, especially if it's steps you take to have India included in some of the new bond indices that India is being considered in. For example, the Bloomberg Barclays Global Aggregate Index.
What I'm hearing from you, Pranjal, is there's no imminent need for to jump in and do something here. You're saying it's orderly 8-10 paisa every 10 days, is what you said on the currency. So it's...
I've been seeing that, but the worry also is that if Hormuz remains shut, every day is sort of aggravating the problem even more because inventories are being run down. So, I won't say it's kosher. I think there is a crisis-like situation in the currency right now. But my sense is we don't have too many options. At some point, we have to just basically get used to an orderly depreciation as long as the strait is closed.
100 is coming on the rupee?
I won't go that far. I'm still sort of working with 96, 97, and then I'm hoping by then the Hormuz opens and then we see a 1 to 2% appreciation, and then we start this depreciation again.
All right, Pranchal, appreciate you coming down to the studio and giving us all of that. For the time being, we hope that Hormuz opens, but as of now, Nacho is getting a lot of, not a chance that the Hormuz opens. So let's see how that goes, but appreciate you joining in. Thanks.
Thank you.
Great to be here.
Well, let's go across to our next management rights. That's the one that we're focusing on. We reported actually a mixed set of numbers in quarter 4, strong revenue growth, margins under pressure. We have Mr. Rahul Mittal, the chairman and managing director at Rights, who joins in. Hi, sir. Good morning and good to have you on the show. A quick word first in terms of the West Asia crisis. How is it impacting your business in terms of revenues, in terms of exposure, if you could quantify it?
Good morning. You see, there would be some impact on, the increase in travel costs, etc., being a consultancy company. But I think that's the only.
There would be some impact on, the increase in travel costs, etc. But I think that's
infrastructure projects, construction projects. All of them have.
That's the only thing which you have to keep a watch out on.
Okay. All right, sir. Let me just come back to you in just a bit. I think we're having a bit of a technical snag out there. But the markets have shown a good recovery, which is good to see. As I mentioned today as well at the start of the show when I did my morning chat, yesterday we fell close to under 120 points from the highs of the day. And there was an expiry-related factor today. And today, given that we were down close to 200 points in the first tick itself, the bulls will find reason to see a bit of a trading bounce. Remember, the global jitters still persist. Bond yields have moved up globally, crude oil prices are higher, and the rupee is still weakened as well. So a trading bounce wasn't ruled out. That seems to be taking place as of now. But what is heartening to see is, yet again, the breadth of the market is improving. When we started today's trading session, you had only around 450 stocks that were advancing. That number, in a matter of 45 minutes, has quickly doubled. They're getting closer to each other. Maybe a bit of a kiss is what we could be looking forward to. So number of stocks advancing is giving some hope that there is still some participation in the broader markets, and that's actually good for portfolios. Individual stocks that are doing well, Hindalco, that's the stock of the morning actually. There was a bit of a buzz there was some buzz that, that numbers could be a little bit weakish coming in from Novelis. But actually what happened in yesterday's trading session was Novelis's numbers actually were quite good.
All right, let's just run through some of the mid-cap action. Z Entertainment is a stock under pressure. That's down nearly about 5%. The ad revenue growth was under pressure. And the stock report, at the EBITDA losses, there were EBITDA losses at the bottom line. There was a loss. Stock is under pressure. So that's down nearly 5%. PI Industries has been weak. We've got Orkla India also a little subdued in trade. And on the way up, Prince Pipes is making a big move. I think yesterday as well, post the numbers, stock was higher. And today it's added on nearly 7%. Dredging is another one reacting well to its numbers. GE Vernova, Zydus Life. There is a conference call which is taking place in Zydus Life where the company is talking about a $300 million kind of a quarterly run rate. That's a stock which is up. But I think we managed to reconnect with Dr. Mittal Dr. Mittal, but Rahul Mittal, Chairman, Managing Director of Rights.
All right, just one more stock, Welspun Corp. I think we should pull up the intraday chart out there. That stock opened on the back foot and that's recovered. And another one is Shelley Engineering. Big uptake is what we are seeing on that one as well. The stock started off lower. The numbers, I think, were a little bit softish, but the street is willing to look ahead. So it's an 8% recovery is what we're seeing on Shelley Engineering. Let's get back to the conversation we're having with Mr. Mittal, though. Mr. Mittal, we have you back on the show. Tell us, quantify the impact, as you said, since you're a consultancy company. It's impacting some part of your cost owing to travel. Tell us a little bit more.
Yes, primarily an impact on the travel expenses, which we'll have to keep a close watch on. As far as our consultancy fee on the construction projects are concerned, the executing agency contracts have price variation clauses in them. And our fee is based on a percentage of the execution cost. So that's not a matter of concern. Yes, we'll have to just keep a watch on the travel costs, both domestic and international, because we have a lot of international projects also.
Okay. Exports were about 25% of your revenue. What's the supply pipeline for exports and what is the growth that you expect on exports for FY27?
See, the biggest key takeaway of this FY was that we had an export revenue of about 300 crores plus after a gap of about 2 years. And that's the revival of our export business, as I said, after this gap. we have an all-time high order book of about 2,100 crores for our international business, which includes project consultancy and export of rolling stock. So I see this figure only growing by at least minimum a double digit in this FY. So our international business, which is a good margin business, will continue to contribute in the coming FY also.
Got it. All right, Mr. Mittal, tell us about your order book. I think it's close to around 9,400 crores approximately. Tell us about the updated book, the order inflow, and if you could break it up for us segment-wise as well.
Yes, we touched again an all-time high order book of 9,400 crores. This was despite a heavy execution of 750 plus crores in Q4. Despite that, our order went up from by about 150 crores in this quarter. As I said, an all-time high order book. We continue to be a one order a day company. We got 120 plus orders this quarter, totaling to about 958 crores. So our order inflow, our track record, which we maintained throughout this financial year of one order a day and one export order a quarter, we continued that even in this quarter, and I see this trend continuing in the coming year. In fact, in the entire year, we got about 580 orders in this FY.
Got that. So on the turnkey side of the business, things are a bit subdued. What were the challenges that you've seen in the turnkey side of the business? What is temporary? What would be structural? And what can you guide going ahead?
You see, turnkey business, if you see the breakup of our order book, is about 4,500 crores. And substantial part, about nearly more than 2/3, is a very young order book. It's about a year old. And that's why you see this jump in order book in the last 1.5 years. So the earlier projects, they were finishing, they were in the final stages. And this young order book of turnkey has started, the execution has started. So this FY will see a much larger contribution from the turnkey segment of business.
Would you want to put a number? Because it's been a couple of quarters of weakness.
Yeah, so as I said, this is because of the mix of the age of the turnkey order book. And I see at least a growth, at least a 10 to 15% growth in the turnkey contribution in this FY vis-a-vis the last FY.
And I missed the number. Did you give a number on the order book?
Yes, our order book is 9,416 crores, which has a consultancy element is about 2,750 crores. The export is 1,750 crores. The turnkey is about 4,500 crores. And leasing and our subsidiary RMCL is about 330 crores. So that is about a total of 9,400 crores, which, as I said, is an all-time high for us.
No, what I wanted to know is what would the number look like? When do you cross 10,000 crore? Do you cross it as soon as Q1 of FY27 with this order a day target of yours?
You see, we will continue to get an order of day. That's the signals that we are getting. But this year, we are going to step up more on the execution, more than a double-digit growth on the top line. So we will definitely reach 10,000 crore. It's a question of the fresh order inflow and the increased execution. But during this FY, we will definitely cross 10,000 crores.
Thank you very much, sir, for joining in. A pleasure speaking with you. That's the management of rights. But now let's talk about the futures and options space. Mangalam is now joining in to get us a check on the sensex derivatives at this hour.
Well, if you look at it, there is the sensex weekly options expiry that takes place, and one day ahead of that, we start seeing some action in a lot of the options. Today, the markets recovered from lows as it did yesterday as well and day before yesterday, though yesterday we saw some supply at higher levels too. The important part, it's the IT pack which is doing extremely well. The BSE is off today's lows by about 250 odd points, and a large part of that could be attributed to BSE IT. And what it also tells you, today's low, is that there is important support around the 74,500 mark. Why do I say that? May 14th, low was 74,526. Today's low, 74,529. If you go below that, then around 74,150 thereabouts are important levels to track on the Sensex too. But at higher levels, there is some supply coming in, and that level is basically both the 50 and the 20-day moving average, 76,345 to about 76,725 are those two levels on the way up that we will be tracking. And option writers are placed for that as well. Given 74,500 as an important support, we are seeing some writing at the 74,000 put, at the 74,200 put as well, telling you that between 74,000 and 74,200 there is support for the Sensex. But at higher levels, the 74,900 call writers are extremely active in trade for a premium of 400 rupees, telling you upwards of 75,200, 75,300. We might see some supply come again as well. So it's about a 1,000-1,200 point range that we're tracking on the sensex.
All right, Mangalam, thanks a lot for giving us that quick update. For the time being, we slip into a short break. But on the other side, Manisha Gupta is waiting for us. She'll focus on the heat wave as IMD warns of a severe heat wave conditions for this week.
Welcome back. Manisha is now joining in and she's going to focus on the heat waves as IMD warns of severe heat conditions this week. Manisha, over to you.
Well, absolutely. When you look at the month of April and May and much part of June as well, the IMD has been constantly suggesting and telling us that the heat wave condition this time around seems quite bad. And I want to take you through some numbers as well. Well, the conditions from 18 to 22nd of May are expected to be of severe heat wave is what the IMD has said. But in the month of April and May, we've seen some very, very high temperatures already. Banda in UP has already recorded 47.6 degrees centigrade Celsius. And when you look at Maharashtra as well, Akola has seen 47 degrees as well. So we have seen very high temperatures already. And there is an expectation from Skymet and IMD both that June perhaps could be looking at higher temperatures as well. There are various international reports which suggest that 95 of the world's 100 hottest cities are actually in India. And that's a bit of a concern coming in there. IMD also has advised alerts for various states and cities in Rajasthan, in Punjab, Haryana, Delhi and UP as well for this week, and you could be looking at extended severe heat wave conditions continuing for the month of June as well. The nighttime temperatures also have been unusually on the higher side. 2 to 3 to 4 degrees higher than a normal is what we have been dealing with. Why is it so hot this time around? Well, one, of course, it is the climate change. We've all been talking about that. Second, it is El Nino conditions developing in equatorial Pacific that has led to more heat and, of course, will lead to, lower rainfall as well in the Indian markets there. It also has to do with the long-term anthropogenic warming. Anthropogenic is when you're looking at deforestation, when you have more industry activity happening. This is clearly man-created, and that is yet another reason that has led to more heat wave. Third is urban areas are hotter than the rural areas. That is because of dense infrastructure, vehicles, air conditioning, industries, etc. So you will see 2 to 3 degrees higher in the urban areas than what we see in rural. And then apart from that, the frequency in India in sense of heat waves and hotter climates has been put consistent upward trend since 1961 there. We also are looking at lower than monsoon this time around. IMD and Skymet have given their initial projections, and IMD talks about 92% of rainfall, while Skymet at 94%. This is both below normal monsoons there. When you look at the India water woes, that really is a concern going forward now. Kharif perhaps is something that we could still see fine, but we are still struggling with soil moisture, and Rabi going forward could be a bigger problem as well. This is the data from CWC which says that 13 major reservoirs in India are below 50% right now. Major water level decline is what we are looking at in south and eastern part of India. When you look at the overall number, and this is the CWC data from 14th of May, it says that of the overall capacity, only 34.45% of water capacity is available to the country at this point in time. Also, when you look at the river basins, well, that has been declining as well. Ganga stands at 43%, Godavari at 36.5%, Narmada at 34 or 35%, and Krishna at a concerning levels of 19.3%. Also, when you look at the southern and the eastern part of country, the water capacity right now stands at anywhere between 20 to 30%. There are concerns on drinking water supply, irrigation, and power generation going forward as well. So various concerns coming in. And the major concern, of course, also comes in the fact of Kharif crops. The sowing would begin from the month of June. You have important cereal crops like rice, maize, bajra, jowar. You also have oil seeds like soybean, groundnut, sunflower, sesame, and then cash crops like cotton, sugarcane, jute. And then you have major pulses as well like tuar, moong, urad. Almost all of them are slated to be sown in the month of June therein. Remember, most of these crops are rain-fed. Irrigation is 55% of India, but 44 to 50% is still rain-fed, and that is where the concerns are coming in from.
Thank you very much for that important topic, and we'll keep coming back to it. For now, it's a break. On the other side is a special segment. It's the economy. Lata's back, and she speaks to Citi's Samiran Chakraborty on the rising pressure on India's macro. Stay tuned.